My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. If you're watching this guy might have a pretty familiar looking face because he's very, very well known, especially in the real estate space, specifically in multifamily, and especially if you've been raising capital. Dan Handford knows a lot about all of those things. He is the managing partner, passiveinvesting.com. He's got podcast galores. He's founder, I think, of the Multifamily Investor Nation, right, Dan? Which is
That's
very
correct.
Well known. And he's been doing deals for quite some time and helping other people do deals and raise capital for a long time. So, Dan, welcome to the show. Great to have you.
Well, thanks for having me back, Dave. I really appreciate it. Looking forward to the conversation today.
Yeah, so it's been a couple of years. So just maybe remind folks who aren't very familiar with you a little bit about who you are and what, especially in 2026, what are you focused on this year with your business?
Sure. Yeah. So as Dave mentioned, I'm one of the managing partners here at passiveinvesting.com, and we acquire primarily apartment complexes, but we have actually branched out and acquired additional asset verticals like self-storage, car wash. We also have our own debt fund. We also just launched this year, which one of the things we're going to talk about today is our Regulation A fund, which we've been talking about for many, many years, have never pulled the trigger up until now. And so that's another thing that we're working on this year as a move into 2026.
Very cool. Very, very, very cool. So the buy box has changed a little bit over time. Apartment buildings are still kind of a big thing for you guys, but you're looking at different asset classes. Well, let's talk a little bit about, in your experience, Dan, what has changed the most over the last 1, 2, 3 years when it comes to raising capital since kind of the bubble burst a little bit there on multifamily. What are you noticing on the capital side?
Yeah, really over the last several years, there's been a shift away from equity investing and kind of moving into debt investing because it has, for one of the biggest reasons is that a lot of the bid-ask spreads between the buyers and the sellers have been so wide that it's been very hard for anybody to be able to buy deals right now. There's been people that have been trying to sell deals, and ourselves included. We've tried to sell some deals that have not sold, and it's because we aren't getting the asking prices that we're wanting for the assets, and it's due to the high interest rates. So when the cost of capital goes up, it's a lot more challenging for the return metrics to make sense to be able to bring in outside investors and share that spread. And so we're very, diligent in our underwriting. We want to make sure we're conservative. We have capital preservation at play. And so really over the last 3 years, we have not acquired any additional multifamily assets specifically because of that. And we've looked at assets, we've underwritten assets, we've toured assets, but we have not acquired anything. There is some kind of curtains opening up, we feel like, here in 2026 that'll allow us to kind of go into the multifamily space and start acquiring some more in 2026. But really over the last several years, we've seen a shift into the debt markets. And so specifically, our kind of insight into it is that we actually have a debt fund that we have been running since June of 2020. And we do between about 8 to 12 million a month in loans out of that particular fund. And we have definitely seen our debt fund grow over the last 3 years, even though we have not been acquiring multifamily. And it's because there's this flight to safety and kind of in those lower risk investments. And as the lender, it's nice to be able to have, a good solid returns and have an asset that's actually backing those returns as well. That if for some reason that borrower defaults or whatever, you can take that asset back, turn around and sell it and get your loan money back.
So what kind of properties or what kind of things are you lending money out on from that debt fund, Dan?
Yeah, so that particular debt fund was actually the borrower facing front to that fund is called Rehab Wallet. And Rehab Wallet does fix and flip style loans. So it's primarily people who are doing fix and flips. And one of the things that I think has allowed us to be as successful as we have with it is that we only lend to people who have experience doing these flips. right? So if you go to a fan Merrill event over the weekend, you can't come to us and get a loan, right? Now last year we did launch a kind of an apprentice program, but it's an in-house, very selective apprentice program where we're doing some of the training, our in-house team, and helping kind of hold somebody's hand to be able to get them their first flip. But just to give anybody and everybody a loan to do their first flip, that's not what we focus on. We focus on the more experienced borrowers. We do have a very high repeat borrower rate, but Rehab Wallet is really the borrower facing front to our fund, which is our debt fund.
Very, very cool. So did you make that pivot when things started kind of going sideways in the multifamily space? Is that when you guys kind of said, hey, we want to stay in the real estate business, but we got to kind of pivot, do things slightly different? Is that when that kind of started, or had you been thinking about that before?
Yeah, I'll say kind of, right? Because really the real pivot that really happened was in 2022, as far as like people starting to like not buy multifamily anymore, right? Because they just couldn't, right? Because the interest rates were too high, the returns didn't make sense, and yada yada. But really, COVID is really what caused us to start the debt fund, and it's because when COVID hit, if you remember, that was like middle of March 2020. Then we launched this fund in June of 2020. It's because during that time frame, we were raising money for a deal, actually one of the largest deals that we had ever raised for. Thankfully, we were able to close that deal even during COVID timeframe. It was one of the hardest, most challenging raises we've ever had, but we were able to execute that. But one of the things we kept on hearing from our investors is that I don't know what's going to happen, because if you remember, everything was shut down. Only essential things could happen. And so even like
nobody had to pay rent and all this, you couldn't kick them out. Yeah, all those scary things happening. Yeah.
And even some more like higher paid professionals like attorneys and engineers and IT professionals and physicians, they were holding on to their capital because they didn't know if they're going to have a job, right? So like, we don't want to lock this money up for 3 to 5 to 7 years in an equity investment if I might need it later this year. And so we got together, Danny and myself, we're the two managing partners at passiveinvesting.com. We actually brought in another managing partner for our debt fund, Kelly Garrett. She has over 20 years experience doing in the mortgage and lending space, but also doing fix and flips. She's done over 1,000 flips herself. And so bringing on her experience and the kind of the capital raising piece together was really kind of a match made in heaven. We launched that with our own capital. We put over 7 figures of our own capital into there in June of 2020. We wanted to make sure we can maintain all the in-house servicing and originations and everything, so we can have a lot more control over that, and especially the compliance side of things. And so we put our team in place. We put our institutional level a servicing software in place, and then we didn't actually launch the fund to our investors until October of 2020. And then we were able to raise not all the money, but raise a good amount of money then. But then where we really saw the biggest increase is when we pivoted from doing just equity investments to just the debt investments, because of how the market was kind of presenting itself at the time.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So before I forget, you kind of tickled our curiosity at the top of the show talking about a Regulation A fund. For those of us who don't have the faintest clue what that is, maybe the Coles Note version of what kind of fund that is.
Yeah, so most syndications, most syndications, 99% syndications are going to be either a Regulation 506 Charlie or C, or a Regulation 506 D as in David, right? No, D, B as in Bravo. So there's a 506B and a 506C. Well, those are they have a lot of limitations to it. And even though the 506B allows you to bring in non-accredited investors, you have to have a substantive prior relationship with them, and you can only accept up to 35 of those investors. So we have primarily been living in the 506 Charlie space, where we can only accept accredited investors. Well, less than 15% of the United States is actually an accredited investor. So there's 85% of investors or 85% of the population that cannot invest in these types of investments. Well, with a Regulation A plus fund, it is qualified and reviewed by the SEC, right? Or it's reviewed by the SEC, and they qualify your fund, if you will, and you also have to submit biannual and annual reports, including third-party financial audited financials. And so it's a lot more expensive to set those up. So a typical Regulation D will maybe cost you 10,000 on the low end, upwards to 20 or 30,000 to set that up. A Regulation A fund costs usually 100 or 100 a quarter. Plus, it also takes about, they say 4 to 6 months, but our experience was 15 months. So
Wow.
it
Okay.
also included the government shutdown, because when the government was shut down, they weren't reviewing anything. And so they kind of went dark on us for a good 2 months. But it took us a good 15 months to get it to the point of being able to launch it. And so we actually just launched our Regulation A plus fund, which allows all investors in the United States to invest in this. And the name of our fund is called Cash Flow Bonds. And so if anybody's interested, they can go to cashflowbonds.com. The way we kind of structured this is very similar to our debt fund, where there's different investment amounts, but there's also different hold periods. So you can have your funds locked up for 12 months, 24 months, or 36 months and get a 6, 7, or 8% return. And the minimum investment, instead of being 25,000 or 100,000, or a lot of these other investments are pretty high, this one has a minimum investment of $1,000. So your everyday investor can actually go to this website, sign up for an investment account, and actually fund it with $1,000 and get started with these returns. Because right now it's a great time to do it, because these money markets and saving accounts and things like that, those returns are starting to go down because the 10-year treasury is going down as well.
Okay, Dan. Sounds like a nightmare tracking stuff, finding all these small time investors, promoting this thing. Must be a pretty robust AI type software in the background helping out with stuff, I'm thinking there. But what's kind of the big picture plan of how to get the word out about this? Because again, you're going to need thousands of $1,000 investors to make this worth your while to get the kind of capital that you're needing. So what are your thoughts there? It's a big switch to go after, the truly retail investor versus accredited investors.
Yeah, so it's one of those things that whenever I talk to other syndicators, they have that same response. They have that like pit in their stomach of realizing, oh my goodness, I don't want to have to talk to all these investors. They're only going to be investing $1,000. And so there is technology that we have in place. As a matter of fact, whenever you do a Regulation A plus fund, you have to have a broker dealer associated with you. Mm-hmm. And so our broker dealer, actually, one of the things that comes with them is their software that helps to automate a lot of this. Yeah. And so we have to make sure that we have to make sure that we promote it as best we can. We also have to make sure we have a lot more automations in place, where somebody comes in, they sign up for an account, but they don't complete the investment, or they don't complete some sort of a verification, that there's something that can actually follow back up with them without us having to think about it, of going in and actually following up and trying to make sure that we're not letting certain investors fall through the cracks. But I will tell you that the primary reason why we started this fund is because I've had a lot of people that are close and connected to me that have been wanting to invest with me, but I cannot bring them in because I'm like, oh, I only accept accredited investors. And, so it was for me, it was really an opportunity to allow some of my family and friends that couldn't invest in the past to now be able to invest. And we do have a lot of people that are in our database, if you will, that are following us and kind of know about us. I think the last time we checked, it's between about 50 to 60,000 people that are on our list that we can now launch this to. It's actually being launched officially next week. But it's going to be pretty exciting.
Yeah, you got a built-in audience for this, and even some folks that are accredited might not want to fork out 25, 50 grand minimum. So they get started with 5 or 10 or whatever they want to do with.
We've talked to many accredited investors that are like, I wish there was a way for me to kind of get my feet wet, right? Yeah. Kind of like doing a small
test the waters.
Yeah, absolutely.
Cool. All right. Well, Dan, a lot of people watching or listening to this are kind of in the syndication capital raising space. Are you guys still actively working with other multifamily investors and helping them out, like with the Multifamily Investor Nation, or is that kind of on the back burner these days?
Yeah, so we still do our webinars on a regular basis for the Multifamily Investor Nation. We've never really had a paid coaching program per se or anything. We've done a few intensives here and there, and done a few conferences, but we've never actually done any paid coaching, mostly because I feel like we have to stay focused on our core business, which is our private equity real estate investment firm, and not kind of get overwhelmed with trying to coach students along the way, right, or kind of on the side, and it's also not a lot of money for on the coaching side of things either, right? And I've had people that have wanted me to coach them, and I'm just like, I have to balance my time and my family. I'm married. I got 4 children. I got basketball, and got pickleball, and got soccer programs. Got all kinds of things going on. Exactly. So
So
it's not something we've done.
so you're still doing the webinars and stuff like that. I guess, you guys are raising differently these days. You're focusing on the fund, on the debt side of things. So it's not the typical multifamily syndication of a few years ago. What have you noticed, or what do you see people doing these days on the multifamily side for raising capital outside of a fund?
Mm-hmm. Well, most of the time, the investments are done outside of a fund anyway, right? So, like all of ours, have, as far as our multifamily assets, have been all just single asset raises, right? And so, what I'm seeing now is the same thing, as you're just not seeing very many of them. Like I'm on email lists of a lot of these different groups, and I think last year I might have gotten 4 or 5 the entire year of actual investments that got sent out. This year, I've already received one. But I think 2026, again, the speculation about, I think with the potential, changes with the Federal Reserve, with the new chairman coming in, we'll see some changes. I don't know for sure if we're going to see any significant changes, but to be able to unlock some of these assets that, really need to be sold and changed hands, because there's some, equity in there that just, I say equity, there's investors in these investments that don't have any additional capital to continue to hold the asset. So it'd be great if the interest rate environment was a little bit better, so that they can actually start selling some of these assets. It also allow us to be able to, acquire some more assets. But the primary thing is still, getting content out there, educating, doing podcasts like this, and then also going to conferences. There has not been as many conferences, but there are still conferences out there, and you still have to be in front of people and getting people to kind of know, like, and trust you. And so many people miss that opportunity of, they think, hey, let's just get people to know me, or let's just get people to like me, or let me try people to trust me. The number one thing of that entire thing is to getting people to know you. Because if somebody never gets the opportunity to know who you are, they never make a decision as to whether or not they like or trust you. And so you've got to get yourself in front of more eyeballs to get more people to know who you are, which will allow you to be able to continue to open up your abilities to be able to raise additional capital. Since we launched passiveinvesting.com in 2018, we have acquired over $2 billion in assets and have raised over $800 million from private retail investors. And so those same strategies that we used to raise that capital in the past still work today, right? You still have to go out there and get people to know who you are, so that you can provide additional information and let them hear from you, and send that content out there to allow them to have an opportunity to raise their hand and say, hey, I'm ready to invest with you.
Well, then let me ask you kind of a devil's advocate question there, Dan. So
Sure.
Wiping out all of your platforms, wiping out that whole database of thousands and thousands of people who know Dan Handford and who know your brand and everything else, keeping the knowledge that you have and starting over again from scratch, what would be your first steps to raising private capital today in 2026?
Yeah. Very first thing I would do is I would start an authority platform of some sort, which is very similar to the multifamily investor nation that I started in the very beginning when I got started. I leveraged that platform, built it, and then continued to build it. I started promoting it just on Facebook. I say promote it. I didn't spend any money, right? I just made posts on LinkedIn and made posts on Facebook, and just started to get some organic get organic investors to come into it and start feeding that storm, right? And continue to feed those investors. And what I would do is I would actually leverage my authority platform to get speaking engagements in front of live audiences. And then I started the podcast, right? And the podcast, what we did in the very beginning, I did like a topical format to the podcast. And one of the things I would do is I would open up some multifamily education books, and I would just scroll through the table of contents and go, I'm going to talk on that. And so I would just start talking and get my ideas from these various books. And that's how I built kind of my authority platform. And I would do it that same way again today. And I would also still try to reach out to these people who are putting on conferences. And I actually have never asked to speak on a stage before. But what I would do is I would reach out to the people who were putting on the event, and I would say, hey, I'd like to be able to promote your event to my audience. I have X number of followers. In the beginning, it was a couple hundred, and then a couple thousand, then 10,000. And I would just say, hey, I'd like to promote your event to my audience. Can I have a promo code to give them a discount? And they would say, oh, yes. And I can also give you a little bit of a kickback to be able to promote it to your group. And I said, I tell you what, I don't want the kickback. I would rather you just keep it yourself or just give my audience more of a discount so I can get them to come to your event. And they would say, first off, they would be like, okay, no problem. How about I just at least give you a VIP ticket to the event? And I'd be like, sure, that's great. So the first time I'd go to the event, I would just show up there. I'd have my VIP badge on. I didn't pay for it. I just helped leverage my authority platform and put it out there. And then when I'd get there and start talking to people, if there was an extra spot available on a panel or somebody didn't show up, they'd invite me to speak on. And then the next year, they'd actually reach out to me ahead of time and they'd say, hey, would you be interested in speaking on my stage? Right. And that's really kind of how I really launched the platform from the very beginning.
That's really smart, Dan. So it was all about giving value, not really asking for anything overt right up front, getting yourself in there, providing more value at the event, being willing to jump in and speak on a second's notice if somebody didn't show up, which happens quite often. Yeah.
I think the biggest thing that holds people back is they feel like they don't know enough about a particular space to be able to start an authority platform. But in the beginning, I didn't know as much about it either. But the way I learned a lot is starting the authority platform and having to do the research on the actual space itself. And I absorbed all of that information to be able to start teaching it. And you have to also ask yourself, like, if you're in a room full of 10 friends, right? What makes you an expert on that particular topic? It's if you know more than them on anything on that topic. So if you know more than somebody else, then you're an expert in their eyes, right? Mm-hmm. And so if you just think about that, put that in your head, like you don't have to know everything about the space. And sometimes when I would do interviews in the very beginning, somebody would ask me a question. I'd be like, you know what? That's a great question. I'm going to research that and we'll follow up on our next show. You know, like, cause I didn't know all the answers to all the questions right in the very beginning. I think that's one of the biggest things from a headspace perspective that holds a lot of people back is they just feel like they don't have the knowledge in their head to be able to start something like that. And you just need to start it, and you're going to get that knowledge and acquire that knowledge a lot faster by starting that authority platform and just pressing go.
I love it. Dan, if people want to connect with you, find out more about what you're up to, what's the best place? Where's the best place for them to go?
Sure. So you can go to linkwithdan.com. That brings you straight over to my LinkedIn profile. And of course, the two links I already provided to you during the show, passiveinvesting.com. You can find some more information about our private equity group. And if you're interested in looking at our Regulation A+ fund, it's a $75 million Reg A fund. You can go to cashflowbonds.com.
Good URLs. Dan, thanks again for being on the show. Always good reconnecting with you.
You too, Dave. Thank you.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.